The next topic of discussion will be identifying market structure breaks. So MSBs, or market structure breaks, is a shift in the sequence of highs or lows in the opposite direction. So a bullish market structure break is a sequence of lower highs broken by a higher high, and a bearish market structure break is a sequence of higher lows broken by a lower low. So what does that mean? Let's say we're in some sort of bullish market. Prices are moving upwards. We're seeing higher highs and higher lows overall moving to the upside. That sequence of higher highs and higher lows, when that sequence is broken or invalidated, that is a sign of a bearish market structure break, because now we're starting to see a shift to the downside where a bit more bearish market structure will take over, where we'll start to see lower lows and lower highs overall descending. Now, in the reverse, let's say price is coming down. We're starting to see these lower highs and lower lows. Bullish market structure break would be a break from that downtrend, a break from that market structure to the upside, where instead of seeing lower highs and lower lows, we're starting to see higher highs and higher lows, a bullish market structure breaking the previous trend. Now, market structure breaks can be subjective when identifying them. Some require a higher low before a higher high can be considered valid, or a lower high required before a lower low is valid. And the requirement of a higher low before a higher high, and vice versa, is a safer approach, but can be overly stringent. This means, let's say, we want to specifically see a higher low before seeing that higher high. All right, we don't want to just see that higher high. We want to see the establishment of not only one part of the equation, one part of the trend, one part of the market structure, but we also want to see the other part. We want to see what the highs are doing. We want to see what the lows are doing, and if both are meeting the criteria for a bullish market structure to the upside or a bearish market structure to the downside. Now, it's key to study your own trades and the market to see which approach gives you the best results. Do you want to be a little bit more lenient or risky? You want to see that higher low before a higher high, or do you want to see, or you want to just wait for that higher high to be established? That's subjective and really varies from trader to trader. Here, you may wait for more evidence of a reversal, or you might take a more aggressive approach and use less restrictions. And that really, once again, that depends. I personally wait for more evidence. I'm a bit more of a cautious trader. I like to take limited risks and really make sure that the risks that I do take are offset by the great amount of reward that I could make from that. And I personally just manage my risks all the time. Otherwise, it bothers me. That's just the way I trade. But you're free to do whatever you like. Generally, if you have to ask yourself if a market structure break has occurred, and it typically hasn't. If we're in a downtrend and you have to ask, oh, is this a recovery? Is this the reversal? Is this the bottom? If you have to ask if a market structure has occurred, it typically hasn't. And it's not just about the bottom of the market. It's really about seeing what the general trend is doing. Was there a shift in the general trend? Was there a shift in the sequence of lower highs and lower lows, or a shift in the sequence of higher highs and higher lows? That's what we're really looking for, not necessarily just bottoms or tops in a market. So here's an example of a bullish market structure break and a bearish market structure break. We'll focus first on the bullish. So let's say price is coming from highs and we're seeing this descending pattern, lower highs, lower lows, lower highs, lower lows. So price is coming down. We observe a low found here. Here is our high. Price comes back down to produce another low, maybe some sort of lower low. And then price comes back up to here, to our lower high, okay? Price comes back down again one more time. Maybe it produces a low here, but overall, following this low that's observed here, it produces a higher high. So this is where we start to see, well, it can't be a bearish market structure, because a bearish market structure is typically it's made up of lower highs and lower lows. By definition, if a higher high is established, the bearish market structure is invalidated, right? So this is where we consider the market structure break. We're breaking away from that bearish downtrend, that bearish market structure, and price is breaching past. If price produces a higher high, that we can consider a market structure break. Now, for a bullish market structure break, we want to focus on what price does at the highs more than what it does at the lows. We want to see where it's going. Particularly, is it making higher highs? If by indication, if we see that price is making higher highs, that indicates that buying pressure is increasing. Because if buying pressure was not increasing, and selling pressure is decreasing at the same time, that would only occur if the price is actually going up. If we're in a steady downtrend, like what we're assuming here, price is coming down, producing these lower highs, lower lows. By producing a higher high, that's an indication that sell-off pressure is weakening and buying pressure is increasing, especially in this zone. On the flip side, bearish market structure. So let's say market structure break. So let's say price is trending upwards. We're in this uptrend. Price is moving up, and we're coming from this down area. Here is our high. Here is a recent low. Price comes back up to produce an higher high. And then here we see a higher low. Overall, we're still in this bullish market structure. Everything's looking great. Price comes up to here, produces a lower high, and then falls down and produces a lower low. This is where we see a market structure break, a bearish market structure break, a shift in the greater trend, right? We were coming from this bullish trend. Things were moving upwards. We see a failure. I think one of the first signs is that there was a failure to produce a higher high found here, right? That's one indication that, hey, maybe buying power, bullish power is weakening. But not only that, that it failed to produce this higher high than the one before it, it actually failed to produce a higher low. It actually fell below the low before it and produced a lower low. And this is where the market structure break is well defined and is outlined and validated. So for a bearish market structure break, here we want to focus on what price does at the lows more than what it does at the highs. We want to see, is buying power weakening, is selling power increasing? Because if price is producing lower lows, the sell-off activity, the sell-off pressure is mounting and increasing. So big question is, do we want to use candle wicks or candle bodies in identifying market structure breaks? Well, both wicks or bodies can both be used to identify market structure breaks, whether wicks or candle closes in terms of the bodies, both are valid. The main thing is consistency. You want to be consistent in your application. Either you're going to use all wicks or you're going to use all candle bodies. Here are some examples. So maybe you want to use wicks for your market structure identification. You want to look for those extreme lines, those extreme wicks to the upside or the downside to identify what the market is telling you, identifying your environment, what the structure is, and maybe you want to use wicks above or below for market structure breaks. Now, another way you could use this is to use wicks for market structure identification and then candle closes above or below for market structure break validation. This is a popular option. It can be considered a more safer or conservative approach compared to option one. The reasoning behind this is that wicks generally are considered more of the extreme of the candle, whereas some would consider candle closes where the candle closes at that particular time frame, whether you're looking at the daily close or maybe a weekly close, a 4-hour close. Where the candle actually closes gives a true representation of the asset's price at that particular time, and it gives it a more truer and more realistic reading of what price is doing at that particular moment, and especially if you're looking at the most recent candle close and comparing candle close to candle close to candle close. So this is another approach. This is a popular one only because the candle wicks are less extreme and give a much more realistic and much more controlled viewing of the market. And then finally, another way to do this is to use candle bodies for market structure and candle closers for above and below for the market structure break. All three of these are valid. I use a mixture, but one thing is to do is the consistency. You want to keep in mind the consistency. So it really depends on what you find much more appealing to you, what kind of resonates with you and makes more sense. We'll take a look at some examples of that coming soon. But regardless, context is key. Different situations may call for different approaches. Once again, market structure breaks should be apparent. You really shouldn't be trying to force a market structure break, or let's say if we're in a downtrend and prices it's been coming down for weeks or months. A reversal or some sort of market structure break from that downtrend to the upside should be apparent. It should be obvious. Well, price stopped going down lower and it produced a higher high, right? If that hasn't happened, then the market structure break didn't happen yet. And regardless if you're using wicks or candle body closes, it should be obvious. It should be apparent that prices stopped moving in whatever direction you're looking at, whether it stopped going up in that bullish market structure or it stopped going down in that bearish market structure. In terms of time frames, generally you want to use the same time frame of your market structure basis. So if you're looking at the 1-day chart, the daily chart, then a daily close above or below the daily market structure level would help signal a market structure break. So you want to keep things consistent also, not only with the candle wicks or candle bodies, but also in terms of time frames. So if you're looking at the daily chart, if you're using that as your basis for analysis, you want to wait for that daily close or open or the daily wick to help signify if a market structure break is occurring or could occur. So the general market structure and overall trend will often dictate the directional bias of future price movement. So a bullish directional bias, this is where longs are more successful, more likely to be successful. And likewise, in a bearish directional bias, shorts are more likely to be successful. So let's say if we're in a bullish trend, prices are going up, we're seeing higher highs, higher lows. That's the time to either long or buy spot trade. Basically, you're longing. You are buying in the hope and the belief that the price of the asset that you're buying is going to go up in value and you'll be able to sell it at a later date. Now, contrary to that, a bearish directional bias or a bearish market, we're seeing lower highs, lower lows, things are coming down in price over time. This is the situation where shorts are more likely to be successful. Shorting, where you are betting in the belief that you are opening up a contract and you are betting that price will come down lower and you'll be able to profit off of that price difference. Now, a market structure break can act as a shift from the general directional bias. A bullish market structure break, this is where we anticipate another higher high. This can be with or without a higher low. This is what we would consider a pullback. And this is generally a bullish outlook favoring long trades. So we're coming from this downtrend. We see some sort of bullish market structure break. This is a bullish outlook for long trades. Now we can shift in our approach and shift in our directional bias back to the upside. Same thing with a bearish market structure. This is where we anticipate another lower low. This can be with or without that lower high, a pullback to the upside, right? That sometimes they don't always happen. This is generally a bearish outlook. This is where we favor short trades. If you can only longs, I know in some regions you can't short, you don't have access to it. If you can only long or spot buy, this is the time to stay out of trades, take profits, or hedge against that downtrend. So once again, let's say price is coming up, we're seeing these higher highs, and all of a sudden the bearish market structure break occurs, and we see that break, prices are starting to come down. We're anticipating that lower low. This is when we can start favoring those short trades, and we could start to shift our trading style and what we're aiming for in our trades. Now note, you do not always have to trade every single market structure break. They can be used as a signal to a shift in the greater market and a change in the market environment. This is the main thing that we're trying to look for. You don't have to trade every single market structure as it happens. You can use this information to help shift what you're looking for and how you're planning. So if you see a bearish market structure occur, you don't necessarily have to catch the top to short and make profit. Maybe you see some sort of downtrend, it comes back down and pulls back up. Maybe that's where you want to open up your short trade. Likewise, if price is coming down and we see some sort of bottoming pattern and we see maybe a bullish market structure break where we see a higher high and a higher low, maybe price comes up to here, right? From this down part, it comes back up and then it comes back down, but it doesn't necessarily fall back below the lower low. We'll see some examples of this before we continue onwards, but this is the time to start shifting your trade, start shifting from long to short or short to long. And this is just one way to help inform your analysis of the market. So generally, it's advised to trade with the trend. In other words, long in a bullish market or short in a bearish market structure, right? We want to trade with the trend, trade with the current. You don't want to go against the current. Trades taken in the direction opposite of the trend or of the market structure break are considered counter trade trends, and that's what we call trading against the current. You don't necessarily want to do this. Consider shorter holding periods. If you are going to trade with these market structure breaks or trade against the trend, you want to hold for shorter periods. Make sure to take profit sooner. Conservative price targets or taking profit at early signs of price action slowing. So if you see that if price is in this downtrend and all of a sudden we see a bounce to the upside, this is where you want to be conservative with your price targets, right? If Bitcoin fell to, let's say, 42,000 and we see this bounce to 45,000, you don't necessarily want to keep holding in hopes that it's going to go all the way back to 55K. This is the time to be a bit more conservative with your price targets. Take profit at early signs of price action slowing or along the way at set intervals, set increments. Tighter risk reward requirements. This means tighter stops. Don't take on too much risk if you're counter trend trading. This is another time for more active trade management. That involves, watching your trades more, being much more conservative and tighter with your stop loss movement and placement. Maybe if the market is moving successfully in your direction and we're generally in a downtrend, but there was some sort of bounce and you happen to catch the bottom and price is moving up in your favor, this might be a time where maybe you have a moving stop loss that trails behind price. That way you are covered in case price decides to continue to the downside. Remember, if price has established a downtrend or established an uptrend, if it has established a directional bias, price is more likely to continue in that direction than it is to reverse. It takes much more energy to reverse that direction. Another thing to consider is position size. This is where you want to trade with smaller or more conservative positions in counter trend trades versus larger positions when trading with the trend. When you're trading with the trend, you're more likely to be successful in the longer term. This is when you can get away with more mistakes, get away with having improperly placed stop losses or a number of other factors, maybe not taking profits when you should have. When that trend begins to change, that's when you need to consider either changing your directional trade as well, or if you're going to continue trading against the trend, you need to be much more conservative and mindful of your position size, along with all these other concepts. Now, you can reverse these considerations when you're trading in the direction of the trend or of the market structure break. That's why it's generally recommended trade with the trend. If we're in a bear market, that's the time to short. If we're in a bull market or an uptrending market, that's the time to long. Let's talk about some benefits of identifying market structure breaks. So market structure can be used to identify good or meaningful support and resistance levels. A support level, which is just basically a low that preceded a bullish market structure break. Higher high is a strong level of support. So let's say there's some sort of low, and that came before a bullish market structure break, which produce some sort of higher high from the high that was established before. That's considered a strong level of support because that could be seen as a level that price failed to break down below, and selling pressure but bearish pressure failed to break down, and they essentially weakened in power, that weakened in pressure, where buying pressure were increased and managed to produce a higher high. That's a considerable level of support. It was not broken. Likewise, a resistance level, some sort of high that preceded a bearish market structure break, a lower low, is considered strong resistance. We could consider for Bitcoin at the current day, let's say 69,000. That was a significant high that preceded a bearish market structure break because that's when we started to see lower lows. That could be considered as strong resistance. Now, what separates these levels from other support and resistance levels? They preceded a break in the market structure, either a strong level of resistance or a strong level of support. And this could be applied for range trading where retests are deeper, more frequent, and or the higher low or the lower high is less obvious. So if price is moving in a range and it's very tight, it's a very tight range, well, this is where we want to see what is considered, what is a stronger level. Is the support stronger where price is refusing to break past, or has maybe it in the past where price has refused to fallen below that level? That particular level could be considered a strong support level, just like, for example, Bitcoin. If we were to look back, the $30,000 level was a considerable price level, especially in summer Q2 of 2021. Bitcoin's price did fall to about 28,000, 29,000 for about a few days, maybe a week or so. But generally speaking, that 30,000 level was a considerable price level and acted as support generally. And that was considered a preceding support level to the preceding bullish market structure break, where we started to see a reversal to the upside into from late July into August and September. Likewise, with the resistance level, we want to keep an eye out for those levels where price refuses to break past after multiple touches or multiple bounces, and we want to see if those rejections from that upside precede some sort of bearish market structure where we start to see lower highs and lower lows, and therefore fulfilling that bearish market structure environment. So here is another diagram. So let's say here's an example of strong support. So price is coming from these higher ranges. It comes down, produces a low, comes back up, produces a high. Here we see a lower high from the highs maybe established before. It's coming from this higher area. So here's a high, comes back down, produces another low, but generally in the same range, right? It did not necessarily produce another lower low. It comes back up, price does come back up and produces a lower high. So the price movement is starting to constrict, right? We do see price comes back down again, produces another low before the general higher high or the market structure break. Let's say we don't know what happens over here yet. Generally, here we could say this level acts as a significant level of support because price failed to produce significant lower lows on each one of these movements to the downside, each one of these swing highs, right? Price failed to produce a lower low. Now, here we see the beginning of a market structure shift because from here, from this low, price comes up, breaks past the lower high established before and the high before and produces a higher high. By producing this higher high, we're breaking the previous market structure because previously we were in a bearish downtrend, right? Lower highs, lower lows. We're breaking past that and invalidating the idea of, hey, we're still in this bear trend. We're still in this downtrend with this establishment of the higher high. Likewise, strong resistance. So let's say price is in a bull trend. Price is coming up. We're seeing higher highs, higher lows. Price comes up, produces a high. Comes back down, produces a low. Just what is normal in a market. Price comes back up, produces another high, maybe even a little bit higher than this, or maybe it's in the same range. This part isn't necessarily too important. It comes back down, produces a higher low. Here is another high. But here we see price failed to produce yet another higher high, right? Maybe it came right up to this level. Maybe it's just a little bit below. Once again, that could be, it's situational. But here we see a high before a lower low and what we can consider a market structure break. If we're in a bullish market structure, we want to see higher highs and higher lows to fulfill that. Once we see the establishment of a lower low, we see a bearish market structure break or potential for one. This is where we start to see that market shift from bullish to bearish.